Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week, get everything you need to know in 90 seconds at 9 o'clock. With news, we're getting an object lesson on the folly of tariffs. The trade war situation is going from bad to worse. The US President has announced new tariffs on $300 billion of imports from China. Starting on September the 1st, those extra goods will be hit with a 10% levy. This comes after China placed orders for US soybeans and in the middle of negotiations between officials. But this latest tariff action undermines future orders for US agricultural products, and rural prices crashed after the news. Wall Street also went into reverse on the news. Equities are down 1% after being up that much before the announcement. Currency markets have been buffeted, with the Aussie dollar one of the most affected, and bond yields have dived. Meanwhile, in the US economy itself, the closely watched ISM PMI came in lower for July and is now barely expanding, when a rise was expected. Another similar survey points out that this is the lowest level since 2009. And US construction activity shrank in the year to June, as well as falling from May. China's private sector factory Caixin PMI for July has come in slightly better than expected, mirroring the official China factory PMI released a few days ago. It is now essentially at 50, neither expanding nor contracting. There are rays of light, however. New orders and production output are expanding again. In Japan, vehicle sales were up almost 7% in July from the same month a year ago, but that is just a rush to beat a sales tax hike. Overall, Japanese factories are contracting, however. And the Eurozone manufacturing sector is now contracting at its fastest pace since 2012. The Bank of England has cut its forecast for UK growth over the next 2 years to just 1.3% and warned that a no-deal Brexit will hit their economy further and trigger a further drop in the value of their currency. The downturn in global manufacturing has extended into its third consecutive month in July. Production and new order intakes declined further as conditions in many markets remain soft and international trade volumes continued to contract. These negative trends filtered through to the labour market, resulting in another round of international job losses. US Treasury 10-year yield has slumped 12 points so far today to be just on 1.89%. And gold is up sharply, making back yesterday's drop and more, up to $1,442 an ounce, which is a $25 surge overnight. US oil prices fell hard on the tariff news, on fears that demand will collapse. They're down more than $4 to $54 a barrel. The Brent benchmark is just on $61 a barrel. And the Kiwi dollar starts today pretty much unchanged against the greenback at 65.6 US cents. On the cross rates, however, we're much firmer at 96.3 Aussie cents. Against the euro, we're unchanged at 59.2 euro cents. That leaves the trade-weighted index at 71.1. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.